All right. So once again, welcome guys. This week we are going to be discussing stock fundamentals, right? Last week we discussed the introduction to stocks and what are stocks and the different types of stocks. And now with that information, you're now moving into the realm of starting to be able to look at stocks differently and look at how is it that you can start to pick a stock, right? Um, I I go ahead and when I'm picking stocks, of course, I follow I know this company. That's usually how I do it. And then from there, I take a look at a few of the fundamentals, do a few comparisons. And then if I really feel strong about that stock, I'll go ahead and go in. On the other hand, I have gone ahead and made some emotional buying to stock. Someone will go ahead and send me and say, hey, this is a good stock. I don't really do my homework on it and I just hop into it and I end up losing a bunch of money, right? Or I go into a stock and instead of me living by the fundamentals, I get all emotional when it starts to drop and I come out and I lose a bunch of money. So don't get emotional. I know it's hard not to do, right? Because it is your money that's involved. But many times, especially when it comes on to stocks, making emotional decisions can turn south very quickly and you'll end up kicking yourself. Right? So let's start up this show. Okay, so stock fundamentals, right? Stock fundamentals is essentially your financial information, right? So when they're saying, oh, the fundamentals is the fundamentals of the company. And much of the fundamentals of a company that will impact the stock price is the financial information, right? Where do you get this financial information? This is the financial information that is usually found in the quarterly reports and the annual reports. Last week, we touched real quick when we were talking about common stockholders and how there is something called the annual general meeting, and that the annual general meeting is essentially the presentation of these fundamentals, right? So at the annual general meeting, they go ahead and they usually talk about the different aspects of the company that surrounds the fundamentals. And many times after an annual general meeting or after the release of a quarterly report, you'll see a price movement. And that price movement is usually based off of the fundamentals, right? So what are these fundamentals? I'm just saying fundamentals, right? What are these fundamentals? Well, the first one is the company's purpose, right? What is it that the company is doing? You always hear, and this is why you will see at all of these events, the CEO comes and talks about his vision for the company and what they've done and what are they planning on doing. That's the company's purpose. What is it that they've done in the past? What is it they're doing now? And what's their vision for the future, right? The next thing is the financial statement itself. It's all, a CEO will always try and sell things really nice. He's the salesman. But the financial information is the hard, cold facts, right? He'll try and pretty it up, but the figures are still the figures, right? So the financial statement. The other thing is the analysis based off of the financial statement. Like someone goes ahead and give you a financial statement, you're looking and you're like, what am I supposed to do with this? It doesn't really mean much into the stock world until it's analyzed, right? And this is where we're going to talk about just a few of the things as it relates to how to analyze that financial information, okay? So there is a thing where you would hear people talk about, we looked at the fundamentals and we also look at the technical analysis, right? Now, there's a difference between the fundamentals and the technicals, all right? So the fundamentals is based on the financial data, right? So that's going to be your ratios. The technicals, you see all those pretty graphs and all of the candlesticks and those are the technicals, right? And hence technical, where they're talking about moving averages and all the slow moving average and the 200-day moving average. Those are technicals. Technicals a lot of times are based on user sentiment and price action. So the technicals are essentially looking at the sentiment of the investors and looking at the last price action to make a prediction on what is the next price action. So where is the stock going to move next, right? So that's the technical analysis. The fundamentals is using the financial data, and based off of the financial data, determine whether or not where the stock is going to move next, okay? Overall, you want to use both, but when I'm still looking at some of the things, especially as it relates to the Jamaican market and the amount of technicals that are actually available. I don't necessarily want to go into too much of the technicals if it's really not even something that you can make much use of. So that is why I really wanted to talk about the fundamentals. You definitely can use the fundamentals. Now, there is no one fundamental that can be used, right? So nobody can say, oh, if you say, why did you pick this stock? Oh, I picked this stock because I looked at this ratio and it looked good, so I went into it. No, right? When you're looking at these, there's a whole host of things you have to look at. And at first it seems daunting, but let us say you go ahead and set up a little Excel spreadsheet that have all of the things that you're looking at. Each quarter or so, you have 4 stocks that you're looking at. You just pop in these information, bam, bam. You can come up with the analysis. But everything in the beginning does seem daunting, and there's nothing wrong in it seeming daunting, no. But as I said, even if you're going to take this information and then go talk to a financial advisor, at least he won't take you wide, because you'll understand essentially what he's saying, okay? So there are several ratios where we talked about the analysis of the financial data is really breaking it down into ratios, right? And these are the following ratios. The first one is the solvency, right? You have solvency. Solvency is essentially what's the liquidity of the company, right? What's the likelihood that the company is going to become insolvent? Insolvent means the company is done, right? So you want to look at the solvency ratios to see how above water is this company, right? Because remember, you're investing for long term. So if a company is having issues with solvency, you might not want to look there. Profitability, easy one. Everybody talks about this one. Are they profitable? Are they working at a profit or are they working at a loss, right? Leverage. Leverage has to do with debt, right? How much leverage does the company have? You will hear someone say that company is over leveraged. That essentially means that they're surviving purely on debt. And that in itself is not good, right? However, a company does not want to run purely on cash neither. They usually want to maintain a balance, a certain ratio of their debt to actual cash, right? And that is their leverage, okay? Then management efficiency. how well is management utilizing the funds of the company? Are they going ahead, bringing in all of this cash and just putting it inside a bank account? That's not very efficient, right? Are they going ahead and spending on projects that's not yielding any return? What are they doing with the resources of the company, right? So these are the main areas you're looking at. Now, we just spoke about the main areas of the ratios. Now, where do you get the information from? Well, in my opinion, there's three main statements, right? A financial statement contains four statements, guys, okay? Four. You have balance sheet. Nowadays, it's called statement of financial position. That's really long. It's balance sheet. Balance sheet, income statement, cash flow, statement of cash flow, if we're going to be technical, and statement of changes in equity, right? Now, which one am I going to drop off? We'll see. The first one is the balance sheet. What does the balance sheet tell you? The balance sheet is simply the value of the company at a point in time. So they go ahead and the balance sheet is as at December 31st. And the company is valued $1 billion. That's what they're valued at that moment in time. That snapshot, they're valued $1 billion at that time, right? So balance sheet is at a point in time, okay? Income statement, that is an evaluation of the company's operations over a period of time, right? So they'll say for year ending December, you hear the difference? One is as at December, and the other one is year ended December. It's for the entire year, right? It's not for last year. An income statement does not, if you're looking at an income statement for 2020, it has nothing in for 2019 in it, right? It's the performance of the company for that year, right? So that's why it's an evaluation of how the company is doing operationally for that period of time. Then cash flow, we realize which one I dropped off, the equity, right? Equity, I don't really see the point in equity many times, but I mean, the statement of changes in equity is kind of nitpicky. But for this purpose, I say it's the cash flow. The cash flow is the utilization of the company's cash over the period, right? The cash. So the company, if the company went ahead and did a donation and those, and it was non-cash, boom, their cash. What is it? How are they running their bank accounts? That's what the cash flow shows, okay? So what are the main fundamentals to look out for? Now, when I'm looking at a stock and deciding which stock is it that I want to go into, there are some fundamentals that I personally look at, right? As I said, there are tons of ratios out there, and no one ratio is the definite have to hop into this stock ratio, right? It's using a combination of ratios and a combination of information and those things that make up the whole umbrella of fundamentals that helps you decide what is it that you're going to go into, right? So the first one is revenue growth. That's the increase or decrease of revenue period over period. So whether or not you are comparing quarters over revenue grows from first quarter to second quarter, or you're comparing years. Revenue grows from 2019 to 2020, right? The next one is earnings growth. People always say, oh, they release their earnings. Earnings in stock world is earnings per share, okay? When they say, oh, they release their earnings per share, okay? The beta, that seems like this technical thing. It is kind of technical. But what the beta is essentially is, it is letting you know how does that stock move with the index it's in? So is it in the NASDAQ? Is it in the JSE? If the JSE shoots up, is that stock going to shoot up with the JSE? How is that stock going to perform with the index? That's what the beta gives you. Price versus earnings, right? Or PE ratio, right? In Jamaica, I don't hear it mentioned as often, but it's something you can calculate, right? In the States, they talk about it all the time. They're like, oh, this stock had a 17 PE ratio and those type of things. It's the price versus earnings ratio, right? And then finally, is the return on investment. Everybody talks about that one, right? What's the return on investment? Oh, I get 12% return on investment. Well, what is that really saying, right? What is that ROI, return on investment, really saying, right? They just like to sound very important when they just say, oh, the return on investment, right? So now let's break down these same bullets a little further on, okay? All right, sales growth. We talked about sales growth. Sales growth is calculating the rate of sales, the growth rate of the sales of a company year over year, quarter over quarter. You use this really to determine, you have some companies that are seasonal, especially if you're looking at quarterly information, right? Like retail, if they are, let us say, for instance, they're a bakery and at certain period of the time, their thing goes up. Well, then you start to develop a level of expectation. You see, all of this is you are looking for levels of expectations, right? You look at historical information to make a future prediction. So your future prediction has to be something that you expect. So you're going to look to see if there's any seasonality in it. You want to see if there was an regulatory change that happened, and then all of a sudden you see their sales start to decrease. That's an impact on them. How is that going to continue? Or they went ahead and they changed CEO. And when they changed the CEO, things changed, right? So you want to look at sales growth. The next one is earnings growth, right? Now, one of the things I'll just cut this is, if time runs out on tonight, we're going to mark the slide and pick up next week, because this is a lot of information I know, and I don't want to rush through with this. All right, so just saying that. Now, earnings. What the main earnings you want to look at is what they call EBITDA, right? People always think it's net income. No, they're parts of expenses that the company has nothing they can do about it, right? And that is the ITA of EBITDA, right? It is earnings before interest, tax, depreciation, and amortization. So interest, usually on the loans, they have not, the interest is governed by the bank. The bank set the interest rate, right? Company have no choice but to pay the interest. So that doesn't impact them. Tax, once again, they don't set that. They have nothing to do with that. Depreciation, they bought some equipment, but they have to depreciate it, and that's an accounting rule. They have nothing to do with that, right? They have to write down their assets over a period of time, right? So how do you know how the actual operations of the company is doing? You remove all of that. Now, the rest of the stuff is exactly how the company is operating. And that is the figure you want to look at, right? And so that is really the earnings. When you hear them talk, a lot of times, even if they release the dollar amounts for the earnings, a lot of times they want to release the EBITDA numbers, because that is actually reflecting the actual operations of the company, okay? Beta, right? Now, beta, as I said, it measures the volatility of the stock, right? How is the stock moving with the index, right? Now, let us say if it's moving the exact same as the index, beta would be 1. So if you see a stock and it says the beta is 1, you don't need to watch the stock. If they say the JSE moved up today, the stock moved up today. If they say the NASDAQ moved up today, your stock moved up. However, that's usually not the case. Now, an underperforming stock will have a beta less than 1. We're not talking about negative figures. We're talking about 0 points. So a beta of 0.90 is moving about 10 notches below the index, right? And the other, vice versa. And when you go ahead and look at a beta above 1, so 1.9, that is a stock that is moving above the index, right? Now, you're saying, okay, so why don't we go ahead and just look at stocks with high betas and just hop in them? Well, they usually tend to be a lot more volatile, right? Lower beta stocks tend to be a lot more stable, and lower beta stocks tend to pay higher dividends, right? So you still want a mix there, right? So you can have some high beta, some low beta. It doesn't necessarily, once again, you want to just use beta. You want to say, oh, this is a 2.0 beta. That means I'm going to make massive gains. No, you're going to use it in combination of other information, right? Price earnings, right? The PE ratio. What that is, it is the comparison of the earnings per share to the share price, right? So at the bottom of a income statement, you will see earnings per share 3.9. Okay, what is the stock trading at, right? Is the stock trading at 4.9? If the stock is trading at 4.9, earnings per share is 3.9. You're going to take the 4.9, divide it by the 3.9, and that's your PE ratio. Okay? Simple. But most of the time, you don't have usually earnings per share is like 0 point something. All right. So that is why you will hear people say, oh, this is a 17 PE ratio. All it is the price of the stock divided by the earnings per share. Now, why is that important? Well, if you find that the earnings per share, the ratio of the earnings per share to the price of the stock is pretty close, that means that that company is pretty well valued. You don't look for much up and down. That stock might end up just staying pretty even. Now, on the other hand, let us say you have you go ahead and you have a very high price earnings ratio. That usually means that they're anticipating that the company is going to do much better than how the company is currently doing, right? And so in essence, it's overvalued, right? Now, could that mean that it's time to sell? It could mean that. It could also mean that in the future, there are going to be some massive gains in that stock as the actual fundamentals catch up with the stock price, right? So that's why you have to look at everything, right? So you have some people who only look at stocks with high PE ratios, right? So with all of these things, you have some people who look at just that one. I go in with high PE ratio stocks. I personally look at stocks with lower PE ratios, right? So even though I look at the combination of the other things, when I'm screening for stocks, I tend to only look at lower PE ratios of maybe like 5, 10, or those things. Because I'm looking for more of a safer bet, right? So yes, I'm not going to get the out of this world, I'm a millionaire overnight, but then I'm also may not or should not get I'm going to chuck off the roof overnight, right? So that's really how they use price earning. Finally, return on investment, right? You know why everybody talks about return on investment? Because it is the easiest one to calculate. You go ahead, you purchase a stock at $100, the stock grew and it is now $102. You take that $2 difference and divide it by 100, that's your return on investment. Boom, that is it, right? Your return on investment is simply the growth or the decrease of the investment over a period of time divided by the initial investment cost, right? So if you go ahead and you bought with Cinco stock at $100 per stock, you bought it last year, you look at it this year, you take that difference, divide it by your original thing, and that is your return on investment for that period, right? So ROI, PE, ROI, PE, beta, sales growth, earnings growth, those are just small ones. I touched on these because these are what you hear about the most, right? But all of them are to be used in combination. Like for instance, how I said I look for low PE, is low PE and low beta stocks I look for, right? So anytime sometimes if you're screening for stocks, some of these things, if you already know it, then you can screen for it. ROI, what are you looking for? Are you looking for an investment that is likely to give you a 20% increase year over year? Okay, look at that, but don't look for it to have a low PE or a low beta, right? Because 20%, that's a good movement. And so you're going to have to go a little bit up on the volatility range for that one, right? No, finally, I didn't even change the slide because after all of these things, what do I say? Do your research. Don't just take my word for it. Don't follow just my investment strategy, right? Your investment strategy is your investment strategy, and you need to figure out what is your investment strategy. I gave you some information now that you can go ahead and start looking at, right? One of the things that I start to do before I want to make an investment is I look for, let us say I want to stay within financial stocks. Okay, what I'm going to do is do my screen, and I'm going to look for the low beta, the low PE ones, look at those, and then I'm going to do a surface look at the other things. What's their return on investment? What's their revenue growth? I do that. Then now I go ahead and align them up side by side with all of this information, and I watch them, right? So I look and then I say, okay, this one is looking a little better. Let me see how they perform next quarter, right? And if the performance of next quarter is right in line with what you were expecting, right? So if you say, okay, their earnings growth was 10%, you're expecting to see another 10% or 12% or more. So if next time you see it drop to 5%, let me hold the brakes on that. Let me see the rest of the fundamentals, right? You go ahead, you look at another one. You still want to keep that. I compare purchasing stocks to like purchasing a new car. Nobody gets up that morning and say, I want a new car, and just walk into any dealer and just pick up any car and then head out. You know about the car, you know about the dealer, you know about the make, you know the model, you research the features, you look at you look at what are the other models. So if you want an Audi, you're going to look at the other models that are comparable to the Audi and see what are the benefits, what are the pitfalls, and all of those things. But then you're putting in that research for a depreciable for an asset that's going to depreciate over time. That's not giving you any money. But then you want to go ahead and pick a stock overnight. that the whole purpose of it is to plan to give you in the long term. No, take the time, do the research, right? While you're learning, do research on some stocks and then look and see what the analysts say, right? So go ahead, do the research on some stocks, come up with your own assumption as whether or not it's a buy or a sell, and then see if the analysts are saying that it's a buy or a sell, right? Compare yourself with those that are essentially paid to do this all day, okay? So I know it was a lot of information, guys. I actually made it through in the time. And I really hope that with this, it will help you to elevate your thoughts on stocks, your conversation on stocks, how you look at stocks, how you look at financial statements, and how you look at companies. And therefore, because the whole purpose here is, I know that not everyone here is going to be a retail investor. Some people are going to go ahead and talk to brokers. Well, many times brokers care about their commission, right? So they're going to go ahead and sell the nicest things to you because they're looking for the best commission. So if you are able to have some education behind it, some understanding on what is going on, you'll be able to engage in a much better conversation with them. And sometimes hold them on the crap that they're trying to sell you. Okay? So once again, thank you guys so much for coming out. I mean, I really look forward to this each week. And during the week, you guys give me such good conversations and really pick my brain. And many times that is what I use to determine what's going to be the next topic. So definitely keep it coming. I don't know everything, but this is something we can definitely do together. And as I say, keep supporting my YouTube channel, my Instagram page, and I will see you guys again next Thursday. All right. Bye, guys.